I hope everybody's doing well today. My name is Jeff Gibby. Yeah, as you can see, I've got Tyler Wood, Alex Call. Very, very entertaining guys. Very good presenters. The first thing, though, that I'm going to do for you on this fine afternoon is I'm going to read a legal disclaimer. So let me go ahead and do that. So today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading, and MetaStock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. So that's, I have to say that.
Yeah,
I've only said it a few thousand times. I do want to say thank you for coming today. It's good to see you. I'm glad you came. We have two really good guests, both Alex Cole and Tyler Wood. They've been designing and developing an add-on that we released back in, was it January?
This is my first time.
January for MetaStock. It's done extremely well. Right now we're working on a review with Stocks and Commodities magazine, and they're really, really liking it as well. And it's a product that's been very, very well received by our traders. It's done very, very well. So we're going to go ahead and let them talk a little bit about that and how you can use it in these uncertain markets. And Tyler, Alex, I forget which one of you likes to share their screen. So where is the presentation going?
I'll take that. I'll put my hands on the wheel, take control for today. Even though I'm traveling, visiting some clients in the Southwest, we'll see if the internet connection here is as stable as I hope it is. And just let me know if that is coming through. If you guys can see what I'm looking at.
Looks great. I can see it. You sound good. I'll keep my fingers crossed for the connection, and I'll get out of the way.
Hey. Thank you so much, Jeff. As the good Dr. Gibby mentioned, Alex and I have been working with the team at MetaStock for really, it's just been this year, 2022. And what a time to develop some new trend following tools in MetaStock, which is such an awesome platform. I mean, incredible data coverage, really great programming team. We're going to talk a little bit more about the extra special stuff that they built in using GoNoGo Charts. But today we want to talk first and foremost about how all of us can deal with very uncertain, very choppy, sloppy, crappy, if you've had a hard first quarter markets. And we're going to talk about trend following. It's a common term. You all have probably read the books. You know the fund managers. But let's just dive right into today's presentation. Talking first about a gentleman named John Henry. The name might be familiar if you've read the book Moneyball or seen the movie with Brad Pitt. John Henry is a very successful trend-following investor. Came from pretty humble beginnings on a soybean farm, got into the commodities trade, and understood that it wasn't about buying low and selling high, particularly in the commodities space. You're not looking at different intrinsic values for the various agricultural commodities. You're looking at trends, and prices trend because of human behavior. And what John Henry says is that if you could take all of that emotion, you know, the little narrative monkeys running around in our head, the would be or the could be, the should be, you know, I believe this will happen, I am thinking this way. That's just thinking. Whereas if we can quantify and look specifically at price, we know what actually is happening, and we can manage our risk responsibly, and we can capture those trends when they're working in our favor. So that's what we're talking about today. When we say quantify, this is not some AI machine learning quant guru black box thing. We're not going to try to teach you how to code in Python. Heaven knows Alex and I are not the guys for that. Yep. But instead, we're talking about a rules-based system, an approach to markets that helps us keep those emotions on the sidelines while we're making trade decisions. All right, so I'm going to take you back to, Econ 101, first year of business school. For me, it was in my master's program when I started looking into this. But the expectancy formula tells us that in the four possible outcomes from a trade, you could have a big win. We're all looking for that. Small win, that's great to lock in as well. A small loss. As trend followers, we want to celebrate the small losses. When we're wrong, we want to be wrong small. We want to cut those losers quickly. We want to get out of those trades, which means we're looking for them. We want to find out when we're wrong in the markets as quickly as possible, accept it, and move on. so that we avoid that fourth outcome, which is the big drawdown, the career risk, if you will, from all of our work with the institutional fund managers. Now, we know that as human beings, we're terrible traders. I mean, not just me. I am a terrible trader. But we know all human beings are terrible because we have these cognitive biases. We have these subjective inputs that help us create mental shortcuts. One of the great authors in the space, Daniel Kahneman, and his co-author, Amos Tversky, in the 1970s, were looking at human behavioral psychology. And they said that prospect theory helped identify how much more painful it is for us to lock in a loss than it is to celebrate the joy of a win, which means we're all hardwired to want to lock in that win quickly, right? Capture that joy because it's not as bad as the pain that we have from a loss. And then when we are in a losing trade, we tend to hold on to that. That trade becomes an investment. It stays in our portfolio a lot longer than it should. Go ahead. This is a virtual seminar. Nobody can see you. You raise your hand or type into the chat if you've ever had a trade that suddenly became an investment because you had such high conviction that it was going to come back in your favor. This is not what we want. We're too eager to lock in those profits. We're not patient investors when it comes to sticking with those trends. We're going to help show some tools that will help you identify the probabilities on your side and then stay with those trends. All right. So with the expectancy formula, we're going to throw a chart up here because that explains everything a lot better. We're looking at profitable trading systems along this curve, meaning any combination of percentage of winners and a profit ratio. If you are really great at stock selection and you're getting it right 80% of the time, you don't have to have a huge profit ratio because you're picking more winners than losers, 4-to-1. What we know about winning trading systems is that you could be wrong half the time. But as long as those winning positions are double the size of your losers, you make money over time. So all of the profitable trading systems are out here in this efficient frontier, this horizon, working to maximize the percentage of winners, as well as maximize the size of those winning trades over those losing trades. GoNoGo Charts, what we're going to talk about today, is going to help you, find a higher percentage of winning trades, putting probabilities on your side. But also we're going to talk about process and how you stick with those trades, being a patient investor to capture the meat of the move of long-term trends, and then responsibly manage risk to the downside. So Alex, you and I have been at this for a very long time. I got started with the CMT Association well over a decade ago. We met early on and have been friends ever since. When you invited me to Bloomberg for a joint presentation talking about technical analysis, both to the new recruits at Bloomberg as well as some clients, and talk to us a little bit about the problem with technical analysis, something you've been passionate about for 20 years.
Absolutely. Well, let's get it straight first of all, right out of the gate. I love technical analysis. The only problem, I think, is in the way we apply it that causes complication and overwhelms our own ideas and our own analysis. So technical analysis, you and I both, like you said, we're believers. We've seen it work. We've seen it work statistically. We've seen it tested. We've seen the robust tools of technical analysis used on the desks of the institutional investors that we've worked with for over a decade. But there is a problem, and it's in the way we choose to apply the technicals. And what I mean is that it doesn't matter really where you are in the industry. You could be somebody new. You learn all this great technical analysis. You put it all on your chart, and then you have a chart that you can't read. Price is too small. You can't even see the price bars. You can't find supply and demand. But maybe you're not new. Maybe you're a sophisticated technician who's got a great process that they understand really well. They might be trying to advise clients, and then the client cannot understand what they're referring to. I mean, I used to work with a lot of people on the sell side who would have very good technical process, but by the time they've walked through what they're thinking and why they're recommending a buy at a certain point, the buy side can't really follow along anymore because the chart is complicated. So really from every angle, whether you're a self-directed investor, whether you're new to the financial profession, whether you're experienced in the financial profession, even if you're not trying to advise somebody else, even myself, I would get myself confused looking at a complicated chart. So that's the problem. We complicate things and we're victims of analysis paralysis.
the quote from John Henry, quantifying, that is what technical analysis does, right? We're not looking at earnings estimates. We're not trying to model out what intrinsic value looks like, oftentimes restated after the quarterly call. Technical analysis focuses on something that is completely objective, not subjective. Price is a fact, and it's never restated. So we're very firm believers. And then when you start to layer in all of the really foundational concepts and the important tools that many CMT Association members helped discover and invent over the last 5 decades, you get to a place where now the interpretation of that chart, the implementation of a trade decision, because you've got all of this analysis on the picture in front of you, it becomes subjective. And I don't know if you're like me, Alex, put enough lines on a chart, you can convince yourself of just about anything. Oftentimes they're redundant or they're contradictory indicators. So what we want to do is we want to focus on the solution, which is to keep price at the forefront. We want to make sure that, so I think I may have jumped beyond a slide talking about go-no-go trend, but really what we want to do is just focus on price, eliminate that analysis paralysis. So let's go through the checklist, Alex. How do institutional investors discover when a trend has started and determine when that trend is coming to an end?
Yeah, so we'll build a short, quick process here just to give people on the line a sense of how it might be done in the institutional space. And the first thing you're going to do is just very simply look at the chart. Is price moving in a discernible direction? Because if we can identify the trend, we can profit on the majority of the move, right? So this is an incredibly important skill that we need to be able to do when we're doing technical analysis. And it's simple, right? Price is going from a area on the chart down here, moving all the way up here. Simple, but not easy to put into practice when actually making investment decisions. So first thing you might do is just look at the chart. Do you see a series of higher highs and higher lows, right? And it's easy in retrospect. It's easy to see at this chart after it's been in trend for some time. But if you're thinking about that left side of the chart when you're trying to get started, where do you see that first higher high? You know, where does that come in? That might be your first visual clue that a new trend is being identified. Now, you might want to automate this because we don't want subjectivity. We just talked about that. We talked about John Henry and how we need to remove the emotions and quantify what we're doing. So we might look at something like the Donchian channels. Donchian channels was the main indicator used for entering positions for the turtle traders. You know, if you haven't read about the turtle traders, look it up. Fantastic story about Richard Dennis and how he taught people how to trade. But Donchian channels looks back at a period. There's a look back period, and it says, where is price relative to that look back period? Is it a high for that period? And if it is, let's move that line up. So with that red line is going to track higher highs as price moves through a trend. The corresponding line underneath, the green line, is going to shift up every time the lowest price in a period moves up. So we can see this stepping up through the staircase of trend. And that's maybe our first thing that we want to look at. We could then throw something like Bollinger Bands onto the chart because we know that at the beginning of a trend, Bollinger Bands might be narrow, and we would look to trade in the direction of the break. So if price was to break out of a Bollinger Band above the upper band, when those bands are relatively narrow, then we would think that perhaps a new trend in that direction, and we would trade the direction of the break. But then moving on from that, you might also throw on, wait for it, guess what's going to be on there. It's going to be a moving average. When we were at Bloomberg, we were trying to identify power users of technical analysis, and we didn't even include moving averages. We just didn't think that almost counted as a way of finding technicians, technical analysts. And I would talk to people who would say, "Oh, I don't use technical analysis. I really study the fundamentals." And I would say, well, what's that line right there on your chart? They're like, oh, that's the 50-period moving average. I'm like, okay, so you don't even think of yourself as a technician, but you've got a moving average on your chart. And it makes sense. If you think about price and it's where it is relative to the moving average can tell you a lot. It's inherently bullish if price is above its moving average. If it's higher, trading higher now than it was over the course of its previous short history or whatever length average you use. Then we might look at the oldest confirmatory indicator that we have, volume. Charles Dow would talk about volume way back in the foundation of our industry. And volume confirming the moves that we see in price. We talk about it as market participation. Is the market participating in the move in price? So we'd look at volume to confirm, and then we'd look at MACD or something else perhaps to give us a sense of momentum. And we'd look to see if the MACD is crossing above its signal line, or maybe you look to see if they're both above zero. That would be positive as well. So you can see that as you're building this, you're weighing up the evidence, you're getting a confluence of events, and towards the left bottom of that chart somewhere, you're starting to say, I feel confident now. We've made a new high, price is above a moving average, volume is relatively heavy. We're breaking out of the narrow Bollinger Bands, moving average is crossed above its signal line. And so we're saying, okay, I think I'm identifying what could be the beginning of a trend. But the problem that comes from this is, as you can see, this is a simple process, very, very simple, just for the point of explanation. And already we're starting to crowd the chart. How would you do things like finding key levels, looking at price and where it is relative to prior highs and lows, perhaps supply and demand areas on the chart, looking at those market dynamics that can help you so much. And it becomes more difficult the more you put on the chart.
You start to obscure price, even with a really straightforward and arguably that's a really solid technical process. You want to have a checklist that tells you when you're in trend, and you want to know when those rules have been violated to know that you're going to get out of that trend. But as we talked about, the more indicators you put, potentially they're redundant, sometimes even contradictory, and you start to lose focus on price. So let's talk about the solution, Alex. You developed GoNoGo Trend, which I think it's very funny. The chart that we're looking at right here, simple color-coded bar chart, includes much more information than we even saw on the prior chart in terms of a blended weight of the evidence approach to seeing everything that constitutes trend. So talk to us a little bit about the GoNoGo Trend chart.
Yeah, and it came out of that desire to be able to understand any market quickly and give a complete technical picture to whoever I was talking to, whether it was an oil trader, long only mutual fund manager, portfolio manager, Asia Pac portfolio manager who has a bunch of traders working with him, whoever I might need to be talking to. I wanted to know what the trend is and be able to have a conversation with them. And so what we did was we just color code the price bars based on strength of trend. And what you're looking at here is you can see that the blue colors, the bright blue and the aqua, those represent the strong or weak go trend. So as long as those colors stay in the blues, like you see since the last move here, that's a go trend. When you see pinks and purples, that's a no-go trend, where we would not consider an investment ready for launch, right? If you think about the terminology we use at GoNoGo Charts. And if you see amber bars, which you see sprinkled in there, often in that transition between trend, those are our go fish bars. And this came from you. We both like Jesse Livermore, but you love this quote, perhaps even more than me, that there's a time to go long, a time to go short, and a time to go fishing. So we call those amber bars, where there's not enough criteria being hit, either in the go or the no-go side, to allow us to find direction. We call those go fish bars, those bars of neutrality.
So maybe it was just on my side. You went a little max headroom on me. Sorry for the 80s reference with the internet delay. But just as a refresher, just to review, when we're in an uptrend, we're in go conditions overall, that blended trend following system, we're looking at a strong or weak form of that go trend in the aqua and blue bars, strong or weak form in the purple and pink bars to the downside. Now, it doesn't get a whole lot simpler than this. And the first time that Alex showed me these tools, at the chair that I get to sit in at the CMT Association is just incredible, because I get to see everybody's work. I mean, really innovative, robust, sophisticated tools, just like GoNoGo Charts, but many of which require a real sophistication on the part of the user, that take time to learn, to understand the mechanics. They're perhaps a little bit more work on the part of the user to be able to understand exactly what it is that they're looking at. Don't get me wrong, there's really incredible data sets out there that are distinct for a very distinct purpose, right? But with GoNoGo Charts, the thing that stood out to me was this elegant simplicity of the fact that anybody can use this. right? There's nothing simpler than a go or a no-go, launch conditions if you're thinking about putting a rocket into space. And so that's work that we're really proud of. We've really been thankful to Jeff and the entire team at MetaStock for the implementation efforts and getting that into the charting platform that is so robust. So we're giving it away. That just seems like the right thing to do. Get as many users as possible, trying to simplify their charting process without losing any of the overall technical information in terms of trend. So you can add that template right on your MetaStock charts for free, GoNoGo trend. All we would ask is that when you use it, let us know. How's it working for you? What period are you trading? What assets are you focused on? What kind of investment vehicles do you like to trade? We want to hear back from all of our users and continue to refine this process. All right, so we've talked about how price is so important. When I first started at the CMT Association, it was Ralph Akampora, one of the founders of the group over 50 years ago, who just said, price is a fact. Earnings are an estimate, and they're often restated. There's nothing more objective. And here to articulate that message for us again, Mark Abraham, legendary trend-following investor, says that ultimately it's the dollar-weighted collective opinion of all market participants that determines whether a stock goes up or down, and that consensus is revealed by analyzing price. So we want to keep that at the forefront of our charting. We want to make sure that's our first and most important indicator is price. If you go all the way back to the rice pits of Japan in the 18th century and Monohisa developing the first candlestick charts, they were really focused on price moves. So blue, strong bullish. Aqua, weaker, right? We built in some sensitivity. Weaker go trend. Amber is that neutral or go fish bar. Pink, a weak bearish signal, and then purple, a strong bearish. Let's go through a few of these together here, Alex.
Yeah.
I think the first place to start may be the S&P 500. In terms of a choppy and uncertain market, we got a lot of folks who got involved in this in trading generally in 2020. Anything they bought went straight up. The indices were a straight line up. We got through 2021, and here in the first quarter of 2022, it was no longer a buy the dip moment. Became really volatile, choppy to the downside. Talk to us a little bit about what you're seeing now on the SPY.
Yeah, so really the first quarter was not the place to be for equities, and we talk about that in our research, how you could have rotated out into other things like commodities, but it seems to have bounced, right? We've had a really strong rally the last few weeks that has brought the U.S. domestic markets back into go trends. There was a string of amber go fish bars as it tried to get out of that no-go trend. And then we've seen the aquas and the stronger blue of the go trend come into play towards the end of the chart. We've had a day down right today. I think these were pulled this morning. We gapped down today, but we are still in a go trend, a weak go trend. So we will watch to see if this go trend holds, and if it can, then that'll be a good thing.
Now, one of the things that was probably the first chapter of the first book on technical analysis that I ever read took us back 130 years to the OG, the original technician of the United States, Charles H. Dow. Many of you know him as the founder of the Wall Street Journal, the architect of the Dow Jones indices and the averages, which discount everything. A really great market historian and observer in his own right, obviously coming from the journalist side. But what he talked about 130 years ago was that market participants come into the market and you have waves or different time periods of trend. So when we're talking about choppy and uncertain markets, I think this is really the core lesson here. Charles Dow was a nautical man. He talked about the waves in terms of, the trend in terms of nautical themes. So the primary trend being like the tides of the ocean. This is our very long-term primary trend is going to be influenced by things like the gross domestic product, the macro economy, the underlying fundamentals of the companies that we're investing in. Those things don't change from day to day with news or the narrative machine that's always working on our 24-hour news cycle. These are the long-term trends that are unflappable. Around that, you have the secondary trend. Charles Dow called that the waves on the of the ocean. Now we're going to see that go above and below the primary trend. This is where a lot of technical analysts have made a killing, because you can understand the drift or the overwhelming bias of the markets, and then you can trade that in a mean reversion strategy as it goes above and below the primary trend. Many of you might trade very short-term periods, the intraday, 1 to 5 minutes. We've got clients who are trading 1 minute E-mini futures and looking at statistical arbitrage strategies using GoNoGo charts. That minor trend is going to be influenced heavily by the news of the day. And let's just stop and think for a second. This first quarter of this year, we've got the Omicron variant continuing to threaten shutdowns in major markets, including in China, in Shenzhen and Shanghai. We've got the potential nuclear threat of geopolitical conflict in Eastern Europe. These kinds of effects are going to swamp our minds with a lot of behavioral narrative, a lot of subjectivity about what we fear might be happening. We've got inflation, we've got the Fed potentially hiking, much more aggressively. These are all things that influence the narrative. But what we want to stay focused on, what we want to objectify, is the price, right? So let's look at GoNoGo charts across multiple time frames. Any legitimate technical analysis tool is going to work the exact same way, no matter what time frame we're looking at. So Alex, let's start with the top-down approach, the longer-term horizon that most of our institutional clients start from and focus on.
Yeah, so they're going to have a market bias, right? You want to have an understanding of the larger time frame so that you can trade in the direction of the larger time frame trend. So a lot of our clients will work from a weekly perspective, and right now the trend has just become a go again on this current weekly bar, albeit an aqua bar, but a go trend on the weekly chart. So if you were participating in the trend that we saw through 2020 and 2021, that massive trend, and then you were concerned a little bit about the correction that we've seen at the beginning of this year, the weekly trend shows that the go trend is back, albeit a weak bar at the moment.
Now, when we're talking about choppy and uncertain markets, right? Let's just think about what happened through 2020 and 2021. This buy the dip phenomenon. We wanted to follow that trend. We wanted to stick with it and be patient investors, perhaps even sizing up our positions at these lows. We want to look to something like the GoNoGo trend indicator to tell us that on the long-term perspective, everything is copacetic, right? When you fast forward to 2022 in this first quarter, we knew that there was a structural change. That primary trend had rolled over. We're in no-goes. That means we're going to change our trading strategy, right? The idea of buying weakness into a strong uptrend, that makes perfect sense when the overall regime is in a go structure. And now, Alex, if we wanted to dive in a little closer look, we might look at the SPY on, say, a 2-hour chart. And we can, when we're talking about these multiple time frames, one of the things I want to emphasize is that your minor, secondary, and primary trend might be, 5-minute, an hourly, and a daily chart. You might look to the daily as your primary bias when you're trading those shorter intraday periods. For a large mutual fund manager, it might be, the daily might be where the trade happens. That's the shortest period. And they might be looking at weekly and monthly for a better perspective. But Alex, what are you seeing on the SPY for this 2-hour chart?
Yeah, I mean, so you might be sort of thinking, let's say you are in this is your primary sort of time frame that you might look at. You might be saying, okay, well, the weekly's gone back to a go. The daily is a go, right? Even though it's fallen away a little bit today, but the daily is a go. The weekly's gone back to a go. So maybe now you'd go down in time frame to look for an entry, right? So right now, would you enter right now? No, we're in a short-term no-go, right? Strong no-go. Today and yesterday and the last few days have not been a good spot to be putting money to work. If you're on the sidelines waiting to get in, your larger time frame perspective says that we've returned to a go, hopefully on the weekly. Daily is a go, but if I want to make that entry point a good one, the hourly or the 2-hourly in this case is saying strong no go. So we may wait for this chart, right, to return to a go trend, and that might give us then confidence across all time frames that prices might move higher in the short term and hopefully in the long term as well, given the go trend we're seeing back on the weekly.
You said that really well. In our little adventures together, even within the same firm, when we talk to the portfolio manager and they're thinking about asset allocation and security selection, they're doing portfolio construction, and they're looking at those really long terms. We might then also go down to the trading desk, same account, right? The portfolio manager has a team of traders, and they're looking to get filled at the most opportune times, and they're looking at much shorter term charts to try to get that best fill. Now, time frame is one thing. We also, in an uncertain marketplace, we have to look to the great John Murphy, author of Intermarket Analysis, CMT charter holder, and actually a close friend, who looked at these correlations between asset classes. Alex and I have also studied the works of Marcos Katsanos and others who've helped to quantify what those correlations are and when they change. But you can use GoNoGo charts. We've already talked about across any time frame. They work exactly the same way. You can also look at any asset class. And when markets become uncertain, we have to look to these other relationships to understand what some of the drivers are. Now, whether or not you are trading treasury bonds or high yield, it doesn't matter. You might be an equities only person, but there's a lot of information in the credit market. So we want to look at those trends. We can use these tools from an analytical perspective, even if we're not managing an individual trade in that asset class. So let's just do a quick round robin here, Alex, and talk about the trend across these 6 asset classes.
Yeah, even if, like you said, even if we are in the equity space, you want to diversify as best you can. And knowing that the trend has been strong in the commodity markets, you look for companies, right, that are going to profit from that. What companies might do well in a rising rate environment, right? Those are the kind of things that you get out of doing this kind of around the asset class kind of quick look. And with GoNoGo Trend, you can just put up a multi-chart layout or something like that in MetaStock, and you can say, okay, equities are in a go. It's weakened a bit today, but we're in a go trend in equities. We've come out of that no-go. Treasury bond prices are in a strong no-go. Remember, bond prices move inversely to rates. So rising rate environment, yes, bond prices moving down strongly. Oil, strong go. Really the trade of the year since the beginning of the year had a real pullback after those highs, but now strong blue bars again. Bitcoin is back into a strong go, having had a real struggle for several months. Gold, a go again, like oil and like the commodities, viewed as a flight to safety perhaps for much of this year as the market struggled, but still in a go trend. And then the dollar on the right, hanging on to the go trend it's been in, with a little bit of sideways action, but looking to move higher towards the top right of that chart as well. So looking around the asset classes can sort of help you make sense of what you're seeing on equity specific moves.
Absolutely, Alex. Well said. Obviously, these parabolic moves here in the last month in March scared a lot of investors, thinking that we may have cracked and gone away. This is what we want to do in terms of objectifying what we're seeing on the charts. Trend is still in place, and the weight of the evidence is further to the upside despite the recent volatility. Congratulations, folks. I know it's Wednesday evening, Wednesday afternoon where I am, but you made it to the 50-yard line. We're halfway through this presentation. Hopefully you're already understanding the idea of a robust checklist, making sure that you're using technical tools to understand when a trend begins and then appropriately managing risk to understand when that trend ends. You can do all of that with this free tool, GoNoGo Trend, across all time frames and all asset classes. And here in the back half of tonight's presentation, we're going to talk about current markets, and we're going to talk about the complete GoNoGo chart solution that is also available in MetaStock and some of these sweet tools that Jeff and the crew have built together. So let's dive right in. Let's keep going. We want to talk about this complete solution that includes not just trend, but then also the other foundational or first principles of markets, which means we want to understand momentum, we want to understand volume, and we want to understand volatility. So that top panel that we're looking at, that's the GoNoGo Trend. We just talked about how trend followers really need to be patient and stay with moves to the upside, really need to cut those losers short and understand when a trend has become a no-go. Bottom part of the panel, we've got the GoNoGo Oscillator and the GoNoGo Squeeze, incorporating momentum, volatility, and volume. But first, Alex Cole, let's talk about momentum. One of your favorite subjects to teach, right?
Absolutely. Absolutely. I'm a car nut growing up in the UK, so I always try to talk about momentum when I teach it, for example, at new clients or at Wiley and the CMT prep courses. car acceleration to me is momentum. That's how I like to think about it. So if you were to think about momentum as the rate of change of price, or how fast has price changed, the velocity of the price change, that's what we're trying to get. And that helps us understand the strength of any move in price. So when we think about a car accelerating, imagine you're pulling onto a highway. Around here in New Jersey, the highway speeds are a pedestrian 50 miles an hour, which is not quite like the racing around the country roads in Wales in rally-bred, small turbocharged Fiestas. But you're going to increase your speed fairly quickly, and perhaps at the same rate. So you'll go from 10 to 20 to 30 to 40, increasing your speed quickly. As you get close to that highway speed, you'll still go faster, but you will go faster more slowly. So you'll go from maybe 40 to 45 to 48 to 50. You will still be getting faster, but not as quickly. And so when you get then to that highway speed, what's going to happen? Well, unless you want to, get arrested and thrown in jail, you're probably not going to keep getting faster. So if you think about that, we saw the rate of change of acceleration slowing down, and then the speed tops out, right? You can't go any faster. And then probably you're going to pull over, you're going to get off the highway, you're going to slow down, you're going to go through a town, whatever it is. So when we see momentum decreasing, even if price is going higher, we think that that could lead to a pullback. And that's how we like to think about it. And that's how, if you think about that car example, you have a great example too, I think, about throwing up the baseball. I don't know if you want to get into that now, but it's the same idea.
We've mentioned this a couple of times. Alex is the official subject matter expert in technical analysis, and he and I got to work together a while back at John Wiley & Sons. They produce all of those huge textbooks for the CMT exams. That stands for Chartered Market Technician. And Ralph Acampora, back in the 70s, he taught all of Wall Street through the New York Institute of Finance. So Alex is the modern day, you're going to all be calling him Professor Cole here pretty soon. But when Ralph was explaining it to me, he said, momentum is, he's from the Bronx, everything's baseball with these guys. He said, momentum is like you've got a ball in your glove, you throw that into the air. The moment it leaves your hand, it's going the fastest that it's ever going to go. All of that energy is pushing that ball up into the air. And as it reaches the apex, the highest point that it's going to reach when you throw it, it slows down before coming back down into your glove, right? Catch it in your glove, you throw it back up again, catch it and release. Now we're going to talk a little bit about how momentum, what changes when you don't catch it and it falls to the ground. Let's move right along, Alex. The concept of momentum and the concept of GoNoGo charts, of blending multiple technical indicators. These are the most widely tested, the most widely used pieces of evidence that we've got about markets. But we don't want to clutter our chart again. Let's just talk about this conceptually, what goes into the GoNoGo oscillator.
It's the same thing. We could spend time adding really useful information to our chart in the form of lower panel after lower panel after lower panel. But you add that to what we put on the chart when we were trying to identify trend. Imagine now these two charts merge together, and you're really looking at something that really could be very difficult to understand. But it's the same concept. We blend together the most robust, tried and tested momentum ideas into one oscillator that will give us all the information that we want. So you can still use this in the traditional sense. You can identify the extremes of overbought and oversold, right? Those peaks and troughs of the movement of price still visible on the GoNoGo oscillator. You can also identify divergence easily, which is an incredibly important concept when using technical analysis. So when price makes a higher high and the oscillator does not confirm, makes a lower low, that's like the car still going faster, but more slowly, right? It's price still making a higher high, but not as quickly, not as strongly, with not as much enthusiastic market participation. So we see a lower high in the oscillator. And we also have incorporated volume in that lower panel. And you can see here on MetaStock, that's shown with the blue ribbon. When the ribbon turns from black to blue, that's telling us that there's heavy volume backing the move we see in price.
Now, what a great concept for visualizing the investor behavior that's happening in the marketplace, right? In this chart, as we reach this penultimate high, there are fewer and fewer buyers as the price per share reaches these new levels. That's what we mean by divergence. This is a core concept in technical analysis and CMT level 1 material. We also see positive divergences. When we're in a no-go trend, you could have a lower low in price with a higher low in the momentum reading, meaning there are fewer and fewer sellers at these lower prices. Now, what we're trying to visualize on the chart is all of this investor behavior. We want to understand momentum, but most importantly, there are incredible studies about how you could use a momentum oscillator when a stock is in trend. Keep in mind, a lot of these tools were developed in the 1970s by members of the CMT Association. They were developed in a very range-bound market, right? You get to overbought, it's probably coming to an end. You get to oversold, it's probably ready to mean revert. And in a mean reverting range-bound market, that's how they traditionally used momentum oscillators. But what about when we're in trend, Alex?
Yeah, and this was an area that fascinated me since the beginning of my studies in technical analysis. And a lot of really, really great work has been done by people like Connie Brown, who wrote really great texts about just that idea. And what we're trying to do then is to use a momentum oscillator when in trend to help us stay in trend, to help us know when a trend may continue. And what was found was that these oscillators range. In an uptrend, it'll go overbought, and then it'll go to neutral, and then it'll go overbought again, and it'll go to neutral. And that makes sense. The market moving in those waves, like you talked about earlier, it's okay in an uptrend for people to buy enthusiastically, right? That makes all the sense in the world. Price moves higher on enthusiastic buying, excessive buying. But when it cools off and these oscillators go into neutral territory, if the trend is strong and healthy, we wouldn't expect it to go oversold. Oversold would mean excessive selling, right? Excessive selling in an uptrend, that'd be cause for concern. So what we do is we try to look for the range that these oscillators trade in. Something like the RSI, you could imagine going from 80 to 40, and that's what they came up with. Problem is that they're very, very fast moving, very choppy indicators, and it becomes a subjective game trying to identify those ranges. So if you're looking at a security and expecting support at 40, what do you do if the oscillator comes to 42 or 43? Do you count that as bouncing off support? What if it goes to 38 or 39? Do you get out of your position because we've broken through the support of what we were hoping would be at 40? And we find that it's different on every security we look at. You're manually adjusting those ranges, different on asset classes too. I knew FX traders that would shift those levels because of the way they felt foreign exchange traded versus equities. So it becomes subjective. So what we've done with the GoNoGo oscillator is create the calculation in a way that causes it to go to zero when the momentum inputs are all in their neutral territory. So that gives us an objective level, right, of support in an uptrend and resistance in a downtrend. So if you're in a go trend and the oscillator comes to zero, we know in theory, per the textbooks, we shouldn't see overselling, oversold conditions. So it should find support at zero and rally back into positive territory if the trend is healthy. And that allows us to stay on the side of the trend.
This is the quintessential element of the questions for all investors. Is this a buyable dip, or is this the beginning of the next rollover? So when we're looking just at trend, which is naturally a lagging indicator, right? We're not catching the absolute bottom and the absolute top. We're capturing the meat of the move. When we use that in conjunction with the oscillator, we can see in an uptrend, and again, this is a daily period. For people who are trading in this range on 15-minute charts, that was extreme volatility, right? But when we're in this uptrend, every time the oscillator comes back down to zero, we know we're at an inflection point. And if it finds support and comes back in the direction of the trend, we're off to the races. Now, let's think about how you implement that. When you're a trend following investor and you're looking for those outsized winning moves, you need to be patient. And in fact, for a lot of the PMs that we work with, they actually scale up their position as it continues to work. So they're buying in on this chart here, they're buying in more, they're adding to their position, they're becoming outsized in their position as the trend continues and shows its durability. You can do that by looking to the GoNoGo oscillator every time it finds support at zero. And Alex, maybe we want to talk just a little bit about the really unique data visualization tools that go along with the interplay between trend and oscillator.
Yeah, so again, it's all about data visualization. we believe that technical analysts are the original data visualization experts of the financial industry, because we, instead of pouring through number after number after number and getting lost, we like to visualize what's happening with price. But you can turn a good thing into a bad thing if you overcomplicate that. So what we wanted to do with these icons is keep it simple and not detract from what we're seeing on the price panel, but give that bit of analysis that we can get from the interaction between the oscillator and the trend. So these first icons that you see here are trend continuation icons, and those highlight the return of momentum in the direction of the trend. And we can then know from that that they're relatively low risk opportunities to take part in the trend that we see, because price has cooled off, but we're seeing resurgent momentum in the direction of the trend. So it's telling us it's okay to get involved when we see these trend continuation icons. They're green, the go trend. If we were in a no-go trend, these circles would be red. The second type of icon that you see here are counter trend correction arrows. And this is just, we want to highlight the traditional use of momentum because it's very valuable as well, right? So when you see the oscillator go into overbought territory and come back, think of an RSI coming back below 70. We use 5 and -5 on our oscillator that's range bound between -6 and +6. But when you see that peak in overbought and then it comes off, we're going to highlight those counter trend correction red arrows to tell us that in the short term, prices may struggle to move higher. We may see consolidation either sideways or against the trend in the short term. And then we'd look to the zero line to see if we bounce.
So these red icons, that's the baseball that's about to come back down to your glove. That means we could have a little price consolidation. Maybe it consolidates over time, or maybe it consolidates through price. But we know that those are sort of apex moments as momentum is waning from its overbought conditions.
And as long as you catch that ball at the zero line, right? That's when you know that the trend will continue.
Catch the ball at the zero line. That's where you get these green icons, right? We keep it simple. All right, let's just finish up here. The last of the tools, right? We've talked about trend, we've talked about momentum, we've talked about volume. And now we're going to talk about volatility. So, Alex, this was the last piece of the puzzle for you, right?
Yeah, when I was trying to make sure that I had a complete picture, I wanted to know from a technical standpoint everything I could about a security when talking to clients. Volatility was the missing piece. And if you're familiar with technical analysis, which I'm sure most people are on the line, you've probably read about Bollinger squeezes or Keltner band squeezes, that idea of reduced volatility leading to a breakout. We talked at the very beginning about throwing Bollinger Bands onto that trend identification chart, that process there. We know that when the bands are narrow, we interpret price outside the band in a much different way than when the bands are wide. When the bands are wide, we think, okay, if we trade outside that band, we're going to think about mean reversion plays. But if the bands are narrow and volatility is compressed, we trade in the direction of that break. So we wanted to incorporate that idea here with GoNoGo Charts as well. And what we've done is we tried to visualize that situation without putting more onto the chart. So we overlaid the squeeze onto the oscillator panel. But when we know now, after that last discussion about the zero line, we know how important it is to find subjective, objective support and resistance at the zero line. So when the oscillator stays at zero, we want to highlight that on our chart. And so what we do is we allow the grid of the go-no-go squeeze to climb to a max. It climbs every bar the oscillator stays at zero. There's no directional pull in terms of momentum. Now, there might be a lot of buying and selling, a lot of activity. And in fact, in this case, we can see the blue ribbon right in the middle of that squeeze. That shows heavy volume, right? But no clear directional pull. And so we wait and see which way the oscillator breaks out of the squeeze to give us a sense of direction.
So, I mean, to me, we're just seeing in real time what's happening in the marketplace. So this is a no-go trend. Price is coming down lower and lower. What we see here is the tug of war between bulls and bears. There isn't a directional bias to the momentum. It's hanging out at zero, even on heavy volume. For those who have watched Squid Game, you know that tug of war can end pretty dramatically. And here, being in a no-go trend, we've got this negative momentum. All else being equal, we would expect that it would resolve back to the downside. If this is a healthy no-go trend, but it doesn't. It breaks to the upside. Breaking out of a max squeeze in a trend reversal, now we're off to the races. And we know that the behavior of all market participants is that when there is that war between bulls and bears, when it's decided who the winner is, everybody piles onto that side of the trade. And that's what creates a trend, is that herd mentality, the behavior of all investors to pile in. So we've talked about trend, we've talked about momentum, we've talked about volume, now we've talked about volatility. Alex, let's just talk about how simple it is to use these charts to look at any asset, to look at any tradable security. Answering just 3 simple questions.
Yeah, this is what it boiled down to for me, to be able to talk to anybody in the industry as quickly as possible. You've got all of that information. I mean, hopefully it wasn't too much, and hopefully we explained the importance of trend identification. Hopefully we explained the importance of momentum and of volatility. But really, at the end of the day, you can take that for what it's worth, and hopefully you believe us. But you can just arm yourself with these 3 questions. Do we know what the trend is? Do we know where the oscillator is? And is there anything important happening around the 0 line? And if I could answer those 3 questions, I felt like I could talk to anybody covering any asset, any time frame in the market. So let's just roll through a couple to give us sort of a sense of how we can do it.
U.S. energy sector, the XLE, that was the trade of the year, the highest performer throughout 2021. And boy, did it take off here in the first quarter this year. On a daily basis, we're looking at the U.S. energy sector. So for everybody who's on this webinar, go ahead, throw this in the chat or your questions. What is the trend right now? Let's answer these 3 questions together. Where are we at? We're in a strong go trend condition. We've got blue bars on the XLE. Where's the oscillator at? See it right here in this panel, right? We're down at 0. And being at 0, is there anything interesting happening at the 0 line? Yes. We are building yet another max squeeze, right? A short little breakout right back into that depressed volatility. That prolonged tug of war continues as we try to find resolution for the trend and for momentum. Obviously, volume has lightened up a little bit, perhaps mentioning that we're coming to an end of a period of volatility. This is another one taken directly from GoNoGo Research. Alex, why don't you walk us through this chart of marathon oil?
Yeah. So when we saw that rotation into those cyclical sectors, it's about capitalizing on that with positions. And MRO was a favorite of ours. We've looked at it all year. Right now, it's in a weak go. It's had a couple of bars that have brought it down. Where's the oscillator? Again, really excitingly, because this is where you want the oscillator to really be able to take advantage of that interaction between the two. The oscillator's at 0. So we will watch now to see if it finds support here, which it should if the trend is strong. So if we get a bounce off 0, trend still in place, go trend continuation icon will appear, and we can say all is well with the go trend in marathon oil. If that oscillator does not provide support and we crash through into negative territory, cause for concern, maybe a little bit of a stronger correction ahead.
And here is where I think we need to make the point that Alex and I aren't trying to teach you any one given trading strategy or any one time frame or any one investment vehicle to look at. Instead, you can use these charts on whatever your process is. But let's just think about the implementation. Let's say you haven't yet participated in the oil trade, and you're thinking, well, maybe I should pick up some Marathon or Conoco or you name it. Where would I get in? Well, you wouldn't want to buy in right here at the point where the oscillator is at 0. Potentially, if that finds support and moves back into positive territory, now we know we've got a trend continuation. That's when we enter. Let's say you've got a boatload of this in your portfolio, and you want to know, is this a viable dip? Is this trend continuing, or should I be getting out? Depending on your risk parameters, you might take the first possible exit. If that oscillator breaks through 0 on this daily chart, you might be out, right? That's how we think about implementing these tools and controlling for uncertainty. We develop our rules and we stick to our process. All right. We've talked through a couple of examples. A lot of these are coming from GoNoGo Research. We produce multiple pieces each week, a chart pack every weekend, and then a long form Monday morning pre-market sort of top-down approach to help people get control of their trading discipline. So launch conditions on Saturday, flight path on Monday. We really want to make sure that we look at the weight of the evidence. And for Alex and I, you know, the years that we've been doing this, the massive education bills that we paid for to get our MBAs, the biggest driver is meeting with our clients. These are some of the smartest people in the room, the men and women of Wall Street who are controlling a lot of the funds, and we spend a lot of time listening to them. So these thematic shifts, the commodity super cycle, it's because we're talking to top analysts all the time, and you can see it show up in the charts. So that rotation back into defensive and cyclical sectors here in the first quarter, away from growth equities as we entered that rising rate environment. That's what shows up in research. That's what we highlight in the charts. Premium research, Alex, you want to talk a little bit about all those daily ideas, or
Yeah.
I think in the interest of time, maybe we just look at a couple examples. Yeah?
Yeah, absolutely.
Excellent. So again, for all of our institutional subscribers, daily ideas, great setups. What we're looking at here was an idea in January 26th. Cheniere Energy Partners, just looking at a rising tide lifting all ships. Another great name in the energy space, but it was right back here where we saw that go trend continuation, right? So we're alerting all of our institutional subscribers ahead of this move. And then, of course, we've got the opportunity to get out and buy back in. This is the challenge of trend follow. You might exit and re-enter a position that you were holding just a few weeks ago. But with Cheniere Energy Partners, that was a great trade idea that has played out really well. We'll cruise through a couple of these. And Alex, why don't you talk a little bit about the expert commentary that exists in MetaStock?
Yeah, let's spend the last couple of minutes talking about some of these features that MetaStock has that are so powerful. Expert commentary is great, and it's something that is just so unique to MetaStock. And we try so hard, like you said several times, we are educators. That's what we like to do. Both my parents were teachers. I taught at Bloomberg every month, the new hires coming in, all the new hires at trading desks for Goldman or whoever. And we like to teach this stuff. We've studied it, and we really love to teach it. So we like to be with people, helping them, hopefully helping them understand what they're seeing when using technical analysis. And I just love the commentary in MetaStock because it's like doing that with somebody, but they can do it themselves, right? You can click on any bar on any chart and get that rundown, those 3 or 4 things. All you need to know, where's the trend, what's happening. You can get that without us being anywhere near, just through the commentary that's provided with MetaStock. So if you click on a bar, you will get an interpretation. You'll get what the trend is and what that means. You'll get where the oscillator is and what that means. You'll get told if there's any icon on the current bar or the bar you're looking at, and you'll be told if there's any squeeze happening as well and what that means. And below the interpretation is a thorough explanation of all of those indicators. So it's almost like having this presentation anytime you look at a bar on the chart. So I love the commentary. And then beyond the really commentary, it's amazing.
Really incredible what Jeff and the team have built in there. And, for Alex and I, we recognize the pandemic has not been easy on most families, and whether it's family obligations or your job expectations, sitting down every day and having Alex and I with you in terms of these expert commentaries is really going to help explain all of that as you implement it in your own trading. Now, Alex, we've looked through a lot of examples. Is the idea that we just click through 3,000 charts every morning to decide where we buy, what we're getting into, or is there some way to automate that?
It used to be. That's what it used to be at Bloomberg. You'd have your big list of securities, click, 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 chart after chart after chart after chart. But obviously, the screening, the explorations, as they're called in MetaStock, so time-saving and so powerful. You can search for these conditions. You can search for icons. You can search for different stages of the trend. You can search to see if you've got any securities in a max squeeze across any of the universes covered by MetaStock's data, which is obviously fantastic. And you can then link that straight to the chart, click on a security, open the chart, and work with your explorations seamlessly with the chart. And that's how to do it nowadays, right? Like go through the Russell 3000 and find go trend continuations.
Absolutely. What a time-saving mechanism. What a powerful way to understand all those go-no-go conditions and pull those charts directly into your process. So you've heard it here. Simple, but not easy to implement. That's why we need to reduce the analysis paralysis, those redundant, sometimes contradictory indicators that we all find on our charts, so that we can be disciplined traders. That's what we want to do. We want to keep our focus on price so that we can maximize the returns of the winning trades and cut those losses quickly in a responsible approach to risk management. So GoNoGo Charts is going to help with security selection as well as that trading process. That's how we navigate choppy and uncertain markets. We just focus on the data at hand, focus on the weight of the evidence, and try to keep an objective view rather than succumb to all of the headline news that's in our face 24/7. So Jeff, I really appreciate you setting up tonight's meeting. I realize it's 6 o'clock back on the East Coast. Hopefully everybody who's thinking about cooking dinner for their family has something already in the oven. But I really appreciate you taking the time to do this with Alex and I today. We're really, really thrilled with how this has turned out in MetaStock, and happy to answer any questions if there are any.
No, let's see. Let's take a look at the live stream. If you guys have questions, let us know. I did have a comment, Alex. I love the commentary also. Hanish actually in GoToWebinar talked about US oil a little bit, or USO. And what they had to say is it also broke down below a wedge today. It closed below the 50-day moving average. Is that something that you would recommend people pay attention to, those moving averages? What kind of recommendations do you have around that?
Yeah, absolutely. I mean, a lot of the things that people will look at are built into these GoNoGo charts. So, you know, you may see, if you're looking at, I think on the multi-asset class chart, we had USO in one of the top right of those 6 charts, and you'll see that change the color. You know, something like that may make it go from a strong blue to a weaker aqua, even if it stays in a go trend, depending on what you're looking at specifically. With the reference to the wedge, like we mentioned, we are big fans of traditional technical analysis, which is why we wanted to be able to keep price the focus. We've read the works of Edwards and McGee, one of my favorite technical books, and being able to do that kind of analysis with GoNoGo trend underneath, so you know what the weight of the evidence is from an indicator approach, but be able to see things like a wedge or a triangle, a breakdown but out of a descending triangle or a symmetrical triangle or whatever it is. Being able to see that because you still have the whole price panel is definitely something that we would advise looking at if you've done the research and you've done the studying of pattern analysis.
You know, to that point, we've got institutional clients who have a really strong fundamental process that they go through, and then they need a technical overlay to help with that security selection and trade risk management. We also have folks who are, you know, diehard Elliott wave analysts, or who, you know, really focus on Fibonacci extensions and retracements. You know, Elliott and Fibonacci being two things that aren't blended into the concept of GoNoGo charts. But how great is it that you have a nice, clean price chart in which to do that other analytical approach without losing all of the information about trend, momentum, volume, and volatility. And so I think that we've had a lot of success with clients, those who are really robust technical analysts and those who are maybe more biased to the fundamental side. Both can use these charts in very sophisticated ways.
Right. Perfect. I think I'm going to talk about how they could get the offer and the offer itself. So I want to say thank you. I love having you guys in. You're very entertaining. I love the way you kind of present together. You do such a really good job, and you're always invited. I want to say thanks for coming in.
Hopefully next time I won't be, you know, trapped in a being on the road is never super easy. But this was really fun, Jeff, and thanks so much for hosting us.
Hey, as long as the internet holds out, right?
That's right.
We got lucky. All right, very good. Thanks, guys. So let me go ahead and take over control here, and let's just go ahead and turn the sharing back over to me. And let's go here. We'll go ahead and show my screen. And you guys do such a good job of actually talking about how this kind of goes together. So let me just kind of recap exactly kind of what they talked about. They talked about the GoNoGo trend identification. Obviously, it's a cliche, the trend is your friend, befriend the trend, a rising tide, you've heard it before. I love the way that everything's color-coded and put together. The oscillator, I like the fact that it's engineered to go back to 0. Very, very good. The icons actually automatically plot on the chart, and the squeeze is such a good blend of technical indicators and technical analysis. And I love, personally, the attention to detail that Alex did, and Tyler put into kind of the colors and exactly making the appearance right, because not only does it kind of give you a very good visual indication of what's going on a chart, and a very visual one, it also looks really good. It's very, very pretty. It's pleasing to the eyes, and I think there's something to be said for that. So with the GoNoGo complete package for MetaStock, you'll get the icon change alerts, you get the expert commentary, which I showed, which allows you to get crystal clear English explanations of what's going on for trend state and what's going on every bar. And of course, you'll get the explorations, which I absolutely love, because even after, and you'll be able to kind of open up charts and be able to look at kind of the commentary and see what exactly it's telling you based on trend and icons, and all of that kind of stuff is going to be put together for you. One of the things that is always going to be beneficial for you, even after you're done learning all about that kind of stuff, is the ability to say, okay, I'm an options trader. Here's a list of the 4,500 available options. Which ones have an opportunity? Which ones are in a go state? Which ones have a squeeze? Which one have a continuation on the icons? And those are all things that you can do very, very quickly. I mean, for me personally, I probably give myself about 15 to 20 minutes a day to trade. I'll look at some charts, see if I need to exit, put some positions. But the ability for me to actually go in and say, hey, give me all of the stocks that have a signal to right now, it's amazing. It just helps kind of take out all the trash. It allows me to focus on, okay, here's the opportunities that exist in the market right now. Am I interested in buying them? Oh, yes, no, make a decision, and then get back to work. And I just love it. So scanning for me, the ability to do explorations is an absolutely critical for me to be able to also do my job. So your situation may be different, but I think really the ability, I think everybody has something better to do than look at 3,000 charts. Focus on the ones that have an opportunity. And that's what software is supposed to help you do. Let's ignore the noise. Let's focus on the stocks that have an opportunities. I love MetaStock, and I love the scanner particularly. So in any case, we'll get off of that. The GoNoGo Charts Complete, like I said, we released it in earlier this year, January, I believe it was. It's normally a one-time cost of $1,495. It's $995 is what we're going to do as the webinar special today. So we're going to give you a $500 discount. We're also going to, as part of that purchase, Alex and Tyler and we sat down and did a little bit of a boot camp earlier this year, where we actually talked about how to get the program up and running, how to open up charts, how to look at different signals, all of that kind of stuff. We recorded it. In total, it was about an hour and 20 minutes long. I walked through how to do all the explorations and the scans and how to read the results. That's really, really pretty easy to do, especially if you've done it for a while. But I kind of show how everything works, and they really talk a lot about the analytics. That bootcamp training is included for free because we want you to use the product. We want it to be useful for you. And not only because we do back it with a money-back guarantee, but we also want it to be successful for you. But if it isn't, we do have a really good risk-reward scenario. If you buy it, the one-time cost of $995, if for any reason you decide it's not helpful for your training with the scanning and the commentary and the trend identification and the icons and all that kind of stuff, we'll just give you a refund. Basically, I wish I could get that out of every trade. A very, very zero risk opportunity. So the $14.95 today, $14.95 normally, $9.95 today. You get that bootcamp training, you'll get a 30-day money-back guarantee. And if you haven't heard of MetaStock before, maybe today's the first time you watched one of our YouTube videos. If so, like and subscribe while you're doing it. But if you've just heard about MetaStock for the first time today, we'll give you a free access to our MetaStock real-time with delayed data so that you can kind of evaluate it. You won't pay any extra for that. To give you a little bit of an idea of MetaStock, MetaStock's been rated #1 in its price category now for 28 years straight. 28 years in a row, it's been rated #1. And that's because of the ability to test trading ideas, scan the markets, get this real-time commentary. It's a great engine. In fact, we just did a huge update to it with a new charting engine, but it's been just a powerful program to help people trade, and that's why it's been rated so highly for 28 years straight. So we'll give you a trial to that if you need it. If this is something that makes money for you, that is helpful for you, you're going to want to keep it. Otherwise, we'll give you a money-back guarantee. So to take advantage of that, you can give us a call, 800-882-3040. You can visit us online at metastock.com/saleschat. You can also do it online at metastock.com/GoNoGoA. So I hope you enjoyed the session today. Give it a try, 800-882-3040, and let us know if there's anything that we can do to help. I want to say thank you to Tyler and Alex for coming in, spending some time with us today. They always do. I find I like the way they present, and they do a good job. I appreciate them coming in and spending some time with us. For those of you that came, whether you're watching on GoToWebinar or Facebook or Twitch or YouTube, seems like we're streaming in a lot of different places nowadays. Thank you. I appreciate your coming. I hope you learned a little bit. I hope you enjoyed the class. And I'll say this, stay healthy, stay good. Well, I hope to see you at the next one. Thanks for coming, guys. Thanks, everybody. All right.